All right, what's up, Tycoon? Super excited for today's video. We're going to give you guys a breakdown of the simple moving averages, what they are, and how they are used in the stock market. They're really useful, and many people use them, whether it is retail traders like you and me, or whether it is billion-dollar institutions and hedge funds, right? They all use it. And typically it is best used on the daily chart, or like a weekly, maybe monthly, things like that. Okay. So we'll go ahead and dive straight into what it is. All right. A simple moving average, SMA, is normally what everyone will call them, calculates the average of a selected range of prices, usually closing prices, by the number of periods in that range. Okay. Um, and we'll go into, there's the formula here for how to calculate it. We're on Investopedia right now. They give some really easy breakdowns for beginners. But one thing that I want to do is highlight some of the, popular trading patterns, right? So two popular trading patterns that use simple moving averages include the death cross and a golden cross. So a death cross occurs when the 50-day SMA crosses below the 200-day SMA. This is considered a bearish signal, indicating that further losses are in store. The golden cross occurs when a short-term SMA breaks above a long-term SMA. Reinforced by high trading volumes, this can signal further gains are in store. All right, so let's go ahead and take a look at QQQ, which is the NASDAQ. All right, and we have our simple moving averages pulled up here. Okay, so if you look on the screen here, you can see the 50 SMA is my yellow one, the red is my 100, and the this like bluish greenish one is my 200 SMA. All right, now these are the SMAs that I like to use. Typically the 10, 20, 50, 100, 200, and 300 SMAs are the ones that are most used in the stock market. All right. So we just went over something called a death cross, right? And that is when our 50 SMA crosses below the 200 SMA, and it is a sign, indicates future bearishness, right? So we got that. Okay, we had the crossover here. All right. The stock market tried to rally, and we got rejected at our 100 and 200 SMA. All right. So essentially what you can use these as is you can use these as price levels where other traders and institutions are all looking at these levels, and they're going to use them as a support or a resistance level. When you're trading above the SMAs, they're known as a support level. And when you're trading below them, it's going to be a resistance level where you can expect to meet some resistance. Okay. And the 50 will not be as strong as the 100, and the 100 will not be as strong as the 200. Right. So that's the main thing. So, we saw this golden cross here that already indicated to us further bearishness in the stock market, right? Now, it's not a guarantee, it's just an indicator that you can use that indicate further bearishness. Okay. And sure enough, from the day we crossed was right here. So let's just call it here. And, the market has dropped 13% since that day that we had the original golden cross. Now, it did have a nice rally, and it came up about 5%, but that was not long lived. And as I just showed you guys, we fell down about 13%. So that right there alone is why you should use them, right? It's going to give you, and it's going to give everyone else. You're all going to be looking at the same thing, right? We're all going to be able to see the same visuals for these simple moving averages. Okay. So I'll go ahead and show you guys how to set it up on Thinkorswim. What you would do is you go to studies. Okay. And then you would go to edit studies, and you would just type in simple. Okay, type in simple right here, simple moving average. You hit add selected. Okay, and then once it's in here, you go to edit. All right, and this is where you can put 50, 200, 100, and etc. in there, where you can also change the color. So the length is where you would come in here, you would change the length, you would set it to whatever you're looking for, right? And then you can check your color and make it any color that you like. All right. So, obviously I've already done that, but I just wanted to show you guys that that is how you get it set up on your screen. It's very easy. And then once you do it once, then you just add it in there again, you add it in there again, and you can have as many as you want on your screen using Thinkorswim. All right. So that's how you set them up. All right. And, we're looking at the daily chart. We have a death cross that we just went over. Okay. Two popular trading patterns. A death cross is when the 50 SMA crosses below the 200 SMA. And then a golden cross is when the opposite happens. Okay. When the 50 SMA comes back up and crosses above our 200 SMA, that's when we'll know we'll have a golden cross and a possible opportunity for an uptrend. Okay. Now we're looking at the 20-year 1-day chart, so we can go back in time and we can see here, all right, typically what people do during the bull market when things are in an uptrend is they'll wait and they'll either buy the dip on the 50 SMA or the 100 SMA. And you can see it's very well respected. And, anytime it comes down, it may dip a little below the 100 SMA, but it recovers very nicely shortly afterwards, right? Like for here, let's say you were blindly buying the top here, okay, and trying to get in the market, you could have held it to the all-time highs, and that was a 7% gain. But if you waited for it to dip to the 100 SMA, right, and you buy in, then now that's a 14% gain. So that's why people will tend to wait for them to fall down to a simple moving average before buying in, especially when it comes to index funds and things like that. You typically kind of never want to be buying at the top necessarily. And things keep going in an uptrend, so you want to have some idea of where to buy the dip at, right? So that's what people will do, is they tend to buy the dip along the 50, 100, 200 SMAs, right? And you can see here that we broke the 200 SMA and we're trading below it now. So now this is going to be our major resistance level. So we're not going to be in an uptrend until we break our 200 SMA as resistance. All right. And I'll give you an example of that. We look here in the past, and we have dipped below them all, right? This was the COVID crash here. And then, now we have the 200 SMA as our resistance, and we got back above it. We crossed above it. And then here's our golden cross. All right. So we had a death cross here where the 50 SMA crossed below. And then we have a golden cross where it comes back above. All right. So it's not always a perfect indicator that we're going to see further bearishness. Like, for instance, here, the 50 SMA did cross below, but that was not a valid death cross, and we didn't continue a downtrend, right? But what we did get was the golden cross where the 50 SMA came above the 200 SMA, and we started an uptrend. Okay. And, we can go back and look over the past 20 years, anytime it dips below the 200 SMA, it does not stay there too long, and it ends up recovering very nicely. Okay. So we are in, some bearish territory here. Here's a death cross. 50 SMA crosses our 200 SMA. We get further bearishness. We drop 16 more percent from that day until we recover. And eventually we get our golden cross. Okay. So that's the main thing we're going to be looking at. And if you zoom out to a different time frame, to the weekly chart, okay, and let's just go back 20 years on the weekly chart. And we can see here on the weekly chart that it actually really never gets very below the 200 SMA on the weekly chart. So using that data, I'm going to look now at the QQQ and say, okay, well, things are not looking good. We're starting a downtrend. Maybe I would want to wait to start accumulating some more positions based on the weekly chart once we get closer to our 200 SMA. We've fallen below the 100 SMA, and now we're heading towards the 200 SMA. I can see it's bounced here nicely right around the 200 SMA in the past. It's bounced here nicely around the 200 SMA in the past. You look here, it even came up over here a little bit. Okay, we come down, we get close to the 200 SMA, and we start to recover. Okay, now there was one period where we dipped below the 200 SMA and stayed below there for a while. Okay, if we look from here to here, okay, that's about a year that we were trading below the 200 SMA on QQQ, right? Until eventually we got that golden cross, okay, to where our 50 SMA crosses that 200 SMA, and then we begin our uptrend, and we start riding the SMAs as support, bouncing off the 50, bouncing off the 100, bouncing off the 50, bouncing off the 100, until we have a market correction that brings us closer down to the 200 SMA on the weekly chart. All right. So it's very good in establishing the overall trend in a stock. Okay. And we can look here and we can clearly see that, hey, this is an uptrend. It's not trading below all of the SMAs. It is pulling back, but what's the uptrend, right? Or what is the trend? Because the trend is your friend. Well, it is up. Okay. So we can see that, hey, this thing is in an uptrend. It's pulling back, and it will most likely pull back close to the 200 SMA. And it may go lower than that. It of course has a possibility to go lower, but we know that historically over the past 20 years, buying around the 200 SMA has been a good, on the weekly chart, has been a good buying opportunity, except for 1 year, which was right around the 2008 financial crisis. All right. And we actually had a bear market for about a whole year, and we stayed stagnant, and we traded below the 200 SMA for about a whole year. But other than that, it's been performing very, very well, right? So that's looking at something positive. Let's look at a stock like Tattooed Chef, okay, TTCF. All right, and let's look at this one. All right, and we can see here on our moving averages, okay, and clearly get a trend or an idea of what the trend is on the stock. Right now, I have all these price levels up here. Of course, I was looking to make a trade on this one. We had a nice symmetrical pattern thing here. But look, all of our SMAs are in a downtrend, just going down, 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 down. They're all going down. So you can quickly just come in at the stock and look and get a visual and say, okay, well, hey, this thing is clearly in a downtrend just by looking at the SMAs, right? You can go to Jumia, right? Another one, you can do the same thing, right? And you see here, all right, well, it's not trending up. Our 200 SMA is going down. Our 100 SMA is going down. Our 50 SMA is going down. Is this something that I want to invest in, something that is in a downtrend, right? That's a question you would ask yourself, and you would have to dive into the fundamentals or something like that and look a little bit deeper into the stock to see if it's worth purchasing in a downtrend, right? So I think that it's really useful and effective mostly on these larger time frames and not these smaller time frames. Okay, like you can use it on the 5 minute and things like that, but I think that they're most best on the daily chart and the weekly chart. Okay, those are my two favorite charts to use the SMAs on. And as we can see here, we're looking at our chart. We've been in an uptrend, okay, and we can see now that they are starting to pull back, and we're starting to begin a downtrend based on our SMAs. Just a quick look at the SMAs, right? You don't have to be able to read it too much. But you can just look at your simple moving averages. You can save the study set, so that you would come here after you have edited all your studies, you would hit save study set, and you see I have this one saved already as SMAs. All right, so thank you guys for watching. Hopefully you learned something, and don't forget to like, comment, and subscribe. Okay, I do viewer requests every single week, so if you got a tutorial, a strategy, you have a stock you want me to analyze for you, let me know in the comments below, and I'll make that video for you as soon as I can. I'm out.